The Morgan Report with David Morgan.
David Morgan, themorganreport.com, 6 August 2021. Well, I will start with the stock market as I usually do, and the S&P touched a new record recently. The small and mid caps are showing strength, and with the job reports, the banks and financials are doing well, as well as the bond market. So up and away with the conventional stock and bond investments. And moving to the metals, I have Kitco's page up here after the market's closed, and I don't think any that follow the metals are unaware that Friday, the close for gold was off $41, 77 cents on silver. These are Kitco prices. They're not the CME prices, but they're very close. Platinum and palladium both off. So it technically gold and particularly gold actually is broken down. So again, like I love to say, one day doesn't make a market, but based on where it is, I would look for further weakness. I did an update for the premium members recently telling them that I saw silver going to probably the 22 level. Doesn't mean 22.00. It means in that range. And of course, again, the market knows more than anyone, but I see further weakness, unfortunately. And what's odd about today is that a year ago, gold was hitting a new high in nominal terms, over 2,000 an ounce, and everybody was rah-rah and very happy. But a year later, here we are at about $300 under that level. Well, I think it's important to acknowledge the fact that premiums have started to drop. This is true. Bob's referring to the Philharmonics and the Britannias, pretty much across the board, Maples, everything else. Talking to the wholesalers, there isn't really much selling back, but there isn't any buying either. So when the market goes sideways in silver, usually it's when it's the least active. There's buyers that are waiting for it to drop lower, and there's others that are just holding and waiting. And the best way to take advantage of that's a sophisticated technique called selling puts. It's a great way to take a premium. You have to have cash in your account. It doesn't have to be, futures account, although that's the easiest way to do it. And you pick a price, like, I don't know, let's pick one for silver, 24. And you sell the put for, make up a number, 75 cents. So what you're saying to the person that buys the put, you've sold it to them, you will get the silver, you will get put the silver at $24, but you've already made 75 cents on the transaction, so your actual price would be $23.25, and you get the silver at that price. So you know ahead of time what you'd be buying it for. Usually if you can watch it go sideways for a while, you can sell puts underneath the market and never actually get put the silver. But if you do, you know ahead of time that you're willing to take silver at that price. And usually it's a pretty good price once the market started to bottom, which right now we don't know. As I just showed you a minute ago, we have some pretty big drops in both gold, silver, platinum, palladium. It's going to continue probably to waterfall. There'll be some probably bounce back early in the week, but I think the overall trend is going to reach a bottom. As I've said many times, the seasonalities for the precious metals is usually the bottoms are hit in August. We're at August 6th. The month isn't over, and probably the safest time to buy will be after the bottom is established. So I just mentioned probably the best timing. This is from David Smith, who works with us here at the Morgan Report. This is posted on SilverSeek, why you should top off your silver and gold holdings before Labor Day. I won't read you the article. You know where to find it. David's he's a wonderful guy, and he also gives credit to a lot of other people. So he's quoting here Adam Hamilton, Craig Hemke, Peter Solifay, if I got close to your last name, Peter, I hope so, Michael Oliver, several others. It gives you kind of an overview of the thinking of why is a good time. It's hard to catch a falling knife. As I said, we're probably going to see lower prices, but no one knows. Certainly, at the level we're at now, it's a lot less with a lower premium than we saw from about, let's say, February on until the last month or so. Next up is from Zero Hedge, a consumer credit source most on record as credit card borrowing hits an all-time high. Certainly a quick article, really, to read over the weekend. So I'm going to expand a little bit on this. This is from ProQuest, and it was on the Wall Street Journal Online, May 2021. Title of the article, How Credit Cards Affect Our Brains and Our Spending. Buying with plastic doesn't just eliminate a barrier to buying, it actually encourages purchases, a study finds. I'm not going to read the whole thing, but I'm going to give you some highlights. It's been known for decades that credit cards encourage spending, but why that happens still isn't clear. New research offers some fresh insight into the causes and how consumers might be manipulated in an increasingly cashless society. Research on credit card spending has tended toward the explanation that delaying payment removes a barrier to purchasers in a shopper's mind. A study published in February in the Scientific Reports found evidence of another kind of trigger. Differences it found in brain activity between shoppers planning to use a credit card and those planning to buy with cash indicate that buying on credit doesn't just ease shoppers' inhibitions, it actually encourages purchases, the research says. The upshot? When people are shopping with credit cards and see a product they like, the neural network in the brain that produces a sensation of reward perks up, which seems to create a craving to spend. You're basically feeling more of a reward when you shop with a credit card. Researchers used a form of magnetic resonance imaging, or MRI, to measure the brain activity of the studied subjects as they participated in a shopping exercise. Each participant was shown a total of 84 everyday products over the course of 3 sessions and was asked whether they would buy each product at the standard price. Half the products were offered for purchase by credit card and half for purchase with cash. None of the products cost more than $50. The difference in the shopper's brain activity support the hypothesis that after repeated credit card purchases over time, the brain learns to anticipate the rewards of credit card shopping, according to the report. And that suggests that consumers could be conditioned to spend through the use of various sensory rewards in a new payment system. I think some of you can read between the lines of where I'm going with this. For instance, with digital payments, the use of particular sound or vibration on your smartphone when you make certain purchases, but not others, could, over time, teach your brain to anticipate rewards for buying specific products. Dr. Banker adds that further research could be done to see if the study's theories hold true at higher prices. It also could study consumers who tend to overuse or misuse credit cards to understand further why they act the way they do. The study focused on people who mostly paid on time and used credit cards appropriately. Understanding brain patterns for other types of consumers could help lead to solutions that attempt to preempt harmful spending behavior, according to Dr. Banker. So there you have it. Are you being trained to use credit? What happens when we go full digital, which most things are digital now, but everything's done on, let's say, the blockchain. Central bank digital currencies as an example, and there is no cash. Interesting times indeed. Well, I'm going to end out this week with an article from realinvestmentadvice.com, and the title of the article is Macro View MMT, When Theories Collide with Reality. Very well written in my view. You can print it out and read it if you wish. I'm not going to go through the whole thing. I'm just going to go to the bottom, but I think this is well worth your time. It's probably a 10-minute read or so. Talks about how much fiscal stimulus there's been in the CARES Act, HERO Act, the $1.9 trillion American Rescue Plan, and on, stating basically that we are in modern money theory and that we're just printing and printing away. Also brought up the fact that there is a difference between Keynes and MMT. Keynes said when the economy starts to recover, you should basically stand aside and let the market take over. That hasn't been practiced, and there's a graph here that talks about that. Basically, governments never practice that second part of the Keynesian theory. And so onward we go to more and more, and we see, of course, as everyone knows, inflation is starting to manifest again in a rather significant way. So the Ricardian equivalence is another way of looking at it. It's defined here. You can read that, but I found the conclusion to be pretty interesting. The allure of modern money theory is strong during the current economic upheavals. Such is particularly the case since it makes possible every progressive program from unlimited public works, federal jobs, uneconomic green energy schemes, Medicare for all, free college, free housing, and a host of others. However, as the Mises Institute correctly states, the promise of something for nothing will never lose its luster. So modern money theory should be viewed as a form of political propaganda rather than any real economic or public policy. And, like all propaganda, we must fight it with appeals to reality. Modern money theory, where deficits don't matter, is an unreal place. We will likely continue to pay the price of misguided economic policies that only work in the mathematical formulas generated in ivory towers. Still, in the real world, these theories, while well-intentioned, always yield a negative result. On those, it is supposed to help. It's David Morgan, themorganreport.com. Remember, there's nothing more powerful than the truth, something that's in very short supply these days. I wish you all the best. I'll be back with you next week with another update.